After months of defying both rising interest rates and high inflation, the US economy is finally showing tangible signs of slowing down. And that's what the central bank wanted, to cool the economy and drive down those price rises. But how much of a slowdown is too much? Gross domestic product in the first quarter of this year increased by just over 1%. Compare that with 2.6% in the final quarter of last year. And yet, despite persistently high inflation, consumer spending remains robust, but business inventory investment was sharply down. And that metric is significant to some economists because it suggests employers aren't as confident about the future as they were just a few months ago, amid concerns a recession is on its way. And just after those GDP numbers were released, retailer Gap announced 1,800 layoffs, just months after cutting 500 posts and amid tech companies cutting tens of thousands of jobs. This is the kind of financial pain that the central bank, the Federal Reserve, said it deliberately wanted to inflict upon the economy to cool it down. It's been raising its benchmark interest rate to make life more expensive for businesses and consumers and to try to slow down their activity. But the Fed said it's aiming for a soft landing, not a recession. US President Joe Biden says the latest numbers suggest the economy is merely transitioning to sustainable growth. Even so, some economists now expect growth for the next quarter to be a measly 0.3%. Owen Fairclough, CGTN, Washington.